Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Prime Minister Mark Carney says the federal government will create Canada's first ever sovereign wealth fund to invest in major projects in the coming years. The fund will receive an initial endowment of $25 billion from the Canada Strong Fund and will be professionally managed at arm's length from the government by a Crown corporation. Carney says the goal is to ensure future generations benefit from today's economic growth. Major deal this morning in the energy sector. ARC Resources is being taken over by Shell in a deal valued at $22 billion, including assumed debt. Shell says the transaction strengthens its integrated gas business and expands its footprint in Canada through ARC's Montney assets. The offer is a mix of cash and stock and represents a 27% premium to ARC's most recent trading price. Shares of Poet Technologies plummeting. Look at that, nearly 50% right now after the company announced the cancellation of all purchase orders from Celestial AI. The move came after Marvell Semiconductor provided written notice of the cancellation, citing Poet's disclosure of confidential information. Despite the cancellation, Poet says it remains focused on AI and optical networking. And taking a quick look at the markets. A little bit of an off day after a weekend of uncertainty in the Middle East. TSX down by 0.32%. And heading to New York, it's really not much different. Everybody in the red right now. Oh, look at that. S&P 500, I would say turned the corner, but really that's not much of a turn. It's pretty much a wash. NASDAQ's clawing its way back, but it's still down, and the Dow Jones off by 0.14%. Well, after a wild month for big tech, the spotlight now turns to earnings. This week, reports are expected from several Mag 7 heavyweights, including Microsoft, Meta, Amazon, Apple, and Alphabet. Joining us with his outlook is Brian Mulberry, Chief Market Strategist at Zacks Investment Management. It is a busy week ahead. What will you be looking for?
Well, really, it's about the strength of balance sheet right now. We're seeing a lot of downstream earnings growth over the last couple of weeks in the materials and industrial sectors, all benefiting from the CapEx spend coming from these very large technology companies. So looking at where they are now, we want to make sure that they're still operating at a very good margin, meaning they're still profitable businesses. And it'll be interesting to see what their CapEx plans are for the next year, if they're still increasing spending or if there might be, some type of end point where, we see CapEx kind of flattening off. So that's really been driving a lot of earnings over the last couple of weeks. I think the most critical point this week is what's going to happen with those CapEx plans from the hyperscalers that report this week.
And do the reports have to be great, or can they be good?
Well, I think they can still be good as long as guidance remains strong. That's really what we're learning here. You saw Domino's Pizza earlier this morning, a little bit more of a consumer discretionary name, not a technology name, but they're soft on their guidance and the stock gets beat up by it. So really, the market is less concerned about what's been happening in the last quarter. They're more concerned about what's going to happen over the next year, and will profitability still be in the picture. So I think it's more about what they say about the future than what actually happened over the last 90 days.
All right, and of course the focus with tech is AI as well. It seems to have regained its momentum.
Yeah, there's no doubt about it. I think, the reports of software's demise were a little bit premature, and you're starting to see that one of the limiting factors for the growth of AI is that we just don't have enough available computing power. Everybody's talking about the cost of tokens. Tokens is just another word for compute, and as that expense grows, it's just an indication that there's so much demand out there. So that means the CapEx that has been planned is still going to happen. We need more data centers. We need more available computing power so that we can see what the actual product of AI is going to be. It's limited simply, but there's just not enough compute right now.
And with the next, I think people are calling this the next AI, quantum computing, emerging markets are looking attractive?
Yeah, I think that, there's no question that the efficiency that quantum computing can bring to the table might be disruptive in that you won't need all of those data centers. The hundreds of billions of dollars that are being planned could be completely disrupted by the quantum state if they can maintain it long enough to do the computation that's necessary. So there's no question out there on that plane of technology. There are some emerging side businesses like photonics, because you have to have a laser in order to agitate the atom to achieve the quantum state. Those types of businesses are coming online as well, and they're becoming very attractive.
And is quantum computing ready to take that kind of AI step, or are we still a few years away from that?
We're probably still a few years away from that. It's really kind of a cold fusion type of a moment where they've been able to achieve this state a couple of different times in a small scale laboratory environment. It's not yet ready for commercial use. And so, it really comes down to being able to sustain the quantum state. Can they stack the level of qubits to a point where it really is competitive, with the normal digital computation process that's available in the market right now? There's just not any there yet right now for quantum.
All right, so we stick to oil then, is what.
At the moment, yes.
with AI, quantum, we're talking about all that, but there's still a war going on over in the corner over here. It feels like we've just kind of tucked it away and put a couple of curtains around it. And said it's not much. It doesn't seem like there's much going on there. How much of a factor is it still?
Well, I mean, it certainly weighs on, some of the sentiment that's out there. But in reality, access to crude oil when it comes in the Western Hemisphere there's plenty of supply between what Canada and the U.S. produces, and now Venezuela's coming online in the Western Hemisphere. There's plenty of available crude. It really comes down to the refined products, right? There's not a lot of refineries in the Western Hemisphere, and in the Gulf states, there are some very large refineries, especially in Oman, a liquid natural gas refinery that has a lot of nitrates that come from there. That's fertilizer for farmers in this half of the world and things of that nature. So the good news is most of that buying was already done several months ago. It comes down to how long does the Strait of Hormuz remain a bottleneck for trade. The markets clearly are saying that it's going to open up sooner than later, and we'll have access to those products. Obviously, the worry in terms of long-term impacts on pricing would be that bottleneck stays closed for a long period of time, keeping all of those prices higher. That will eventually lead into the cost of everything at some point.
What opportunities are you seeing here with that?
Well, really, it comes down to some of those alternative energy sources, right? One of the names that we like is GE, because they build, jet engines. And what we're finding is less airlines buying new equipment and really just kind of resurfacing old equipment. So they're just putting new engines on older airframes. That's a durable business. But also outside of that, their technology is going into the ability to generate electricity with that same turbine technology. So using liquid natural gas and a jet engine, you can get a lot of electricity cheap. It's a great stopgap until you can get more power, like from nuclear or something like that, online. So there are definitely some AI adjacent type of trades that look very attractive at this point in time.
All right. And then you're also saying you're thinking financials are looking tempting.
Yeah, I mean, what we understand is there's likely to be more CapEx over the next couple of years. There's also likely to be a lower interest rate environment. The combination of spending and also a lower cost of capital should be good for growth. And we'll definitely want to see those big money center banks get involved, increase lending, help companies go public in terms of a new IPO type of a wave, but also the build out of AI and all of the technology that it's going to bring is going to have some type of financing. So we like the larger money center banks for that reason.
All right, we have to wrap it up there, Brian, but thanks as always for joining us.
Thank you.
Brian Mulberry is Chief Market Strategist at Zacks Investment Management. Well, coming up, Shell is buying Canada's ARC Resources in its biggest deal in more than a decade. We'll break it down further and what it could mean for Canada's energy landscape. That's next. Shell has announced it is acquiring Canada's ARC Resources in a deal valued at $22 billion, including assumed debt. For more on this deal and what it means for ARC shareholders and the signals for the broader Canadian energy space, we are joined by Randy Ollenberger, Managing Director, Oil and Gas Equity Research at BMO Capital Markets. Randy, thanks very much for joining us.
My pleasure.
Okay, initial thoughts on the deal. Is good for Shell? Good for ARC?
Well, I mean, I think it's great for Shell. I think they're getting a very high quality company here at a very good price. So I think it is a very good deal for Shell. I think it's good for ARC shareholders in the sense that ARC had been struggling of late due to some problems with their Attachie development. But at the end of the day, we think that that was going to get resolved. So we do think this is a good deal for Shell.
And for ARC, 27% premium, a good deal?
Yeah, so I mean, it's right on top of our proved probable net asset value, so we think it's a fair deal. But again, I mean, the shares had been under pressure for the last 9 months or so and had underperformed because of some problems they had with their big Attachie development. So it's not like ARC shares had been performing really strongly, and this is a premium over and above that. This is a premium off of what arguably could be considered a relatively depressed level.
All right. Now, what does Shell do with this? Where do they go?
Well, so Shell is the operator of LNG Canada, and the Phase 1 project is up and running. It's producing somewhere in the range of 1.5 to 1.6 billion cubic feet a day of natural gas. It's going to continue to expand that up to 1.82. But this deal, I think, is also a very positive signal that Shell intends to move forward with the Phase 2 development, and that would double the size of this facility. So I think it's a very good signal for the rest of the gas industry.
And is this kind of, I mean, with everything that's unfolding in the Middle East, is this could be a coming out moment for Canada, and that we actually do pursue our gas and oil opportunities far more than we have been?
Well, let's hope so. So, I mean, I think, going into this war, there had been an expectation that the global gas market might have been oversupplied for a few years beginning in 2027. Now, with about 20% of that Qatari production offline for the next 5 years, the market's going to be a lot tighter. And so I think now those major players around the world are probably looking for alternative sources of natural gas. And Canada obviously can provide that, both through our existing facility, but the 2 floating LNG projects that are coming online in 27 and 28, the Phase 2 development, as I mentioned. And then there's another development called SLISMs, which would also be developed potentially by 2030. So hopefully we can get all of these things moving.
And Shell, to a degree, from its side, it needed something too. It was kind of running low, wasn't it?
It did. So, they only were going to stick with the Phase 1 development. They probably could have relied on buying system gas. They already had a deal with ARC, actually, to supply part of their Phase 1 needs. But they certainly couldn't go ahead with Phase 2. They simply just didn't have enough reserves to support the Phase 2 development. So, as I said, this is a pretty good signal that Shell intends to move forward with Phase 2.
And was this on the radar at all? Was anybody talking about this one, or did it kind of was there any rumors floating around?
There'd been rumors that, Shell and other LNG Canada partners will need more gas if they're going to go ahead with Phase 2. Of course, they haven't sanctioned it yet. But the rumors were out there that potentially, if they move ahead, ARC and some of the other players would be potential takeover targets.
And are there any others floating around that we might see? Is this the start of something, or is it one and done?
Well, I mean, it potentially is. I mean, if we look at the other partners in LNG Canada, like PetroChina, Mitsubishi, KOGAS, we believe they are also short reserves. And so if they want to meet the commitments that they would have for a Phase 2 development, unless they sell down their interest, we believe they would also likely need to consider buying some additional gas reserves in Western Canada.
And with that, do you see the government stepping in at all, or maybe nixing any of this, or is it going to be, will it have no problem with the foreign companies taking over?
Well, Carney's trying to get LNG Canada Phase 2 off the ground and other LNG projects, or at least sounds like he's trying to get those projects off the ground. And those projects really aren't going to get off the ground without foreign investment. So, I mean, if the government were to stand in the way of this deal, for example, that would really shut down the LNG industry here in Canada.
So you don't see any problems from Ottawa then?
Well, I don't see any. I mean, as long as Ottawa is serious about building an LNG industry.
And is that our only option? Is that our only way to grow it, is from outside?
Yeah, I mean, these are multi-billion-dollar projects. I mean, we're talking about needing to invest $30 to $40 billion per project if we're talking about these big, large projects. And so we really do need some outside capital to get these things off the ground. And
how much potential is there then in the fields out there?
Well, Well, I mean, I think you could easily build a 10 BCF a day LNG industry off of the West Coast. So right now, as I said, we're only going to be producing 1.5 up to 1.8. That's all that's sanctioned right now, plus another couple of small projects, another 600 or 700 million cubic feet a day. So what we're talking about is an industry that's perhaps 5 times larger than what we have today.
All right, Randy, thanks very much for joining us today. Appreciate it.
My pleasure.
Randy Allenberger is Managing Director, Oil and Gas Equity Research at BMO Capital Markets. Up next, we'll discuss why nations and regulators are concerned about Anthropic's latest model, Mythos, and what this means for the AI race. There is a lot of talk about how AI will change the world, but we're only at the beginning of AI transitioning from assistance to autonomous executions in high-skill fields, particularly cybersecurity. For more on this, we were joined earlier by Gregory Allen, former U.S. government AI policy official.
Anthropic has told them explicitly that they should be worried. For over a decade now, people such as myself have been noticing that machine learning, artificial intelligence capabilities are getting more and more powerful across a whole host of domains. And one of those really interesting domains is in cybersecurity. Now, because the entire attack takes place in the virtual environment, the digital environment, that makes it a really attractive place to gather training data. And anytime you can get a lot of high quality training data, you can build powerful AI systems. And this latest model from Anthropic, Mythos, really crossed a number of interesting thresholds, not just the ability to identify new computer security vulnerabilities, which other AI models had been able to do so previously, but the ability to do so and then autonomously execute the attack from an end-to-end perspective. And going through a number of really important open source code repositories, Anthropic has already found hundreds or thousands of cybersecurity vulnerabilities, many of them critical potential breaches. And so that's why Anthropic went to the government, went to the big banks, went to critical infrastructure providers and said, hey, this exists. You live in a new world now, and you have to be armed against it.
And this is interesting. Cybersecurity, you say, has had a massive labor shortage for 20 years. Because hackers are, well, they're difficult to train, and I guess some of them are difficult individuals.
Yes. So if you think about an agency such as the National Security Agency, that's the best computer hackers in the United States government. There's only thousands of skilled individuals here working at that agency who are really capable of executing a high-quality cyber attack, right? There's not millions of these people on planet Earth. And the number of vulnerabilities that they can discover, the number of vulnerabilities that they can exploit has been for a very long time fundamentally labor constrained. These are experts and the work they do is hard. But what if instead of having 2,000 people in an office campus, you could have 1 million AI agents living in a data center with equivalently good skills? Whoa. And not only there are 1 million of them, you can create more of them essentially at will, and their ability to scale up and act autonomously is basically what you as the decision maker decide it should be. This is a very different cybersecurity landscape on both the offensive side and the defensive side that we're likely to be in the next few months.
Mythos is doing this, Anthropic is doing this, or adopting this approach. They're working with 40 key companies, banks, and government agencies. Just describe them to introduce them to Mythos and its power and its powerful attributes. Just walk us through how Anthropic is handling this, please.
Well, essentially, Anthropic is developing these new capabilities, and it recognizes that all segments of the economy are effectively vulnerable to the existence of these new capabilities. But Mythos, and effectively all artificial intelligence technology, can be used like any tool for good or for ill. The same capabilities that discover cybersecurity vulnerabilities can be used to exploit them offensively or to guard against them and patch them defensively. And so fortunately, Anthropic has, as sort of a good corporate citizen, gone to the government, gone to these key businesses and industries and said, here are all of the critical vulnerabilities that our new model has identified. Before we make this available to our general customers, you need to start patching all of these vulnerabilities. And it's noteworthy that Anthropic is really doing this at a cost to its own business. Anthropic could be serving Mythos to customers and earning revenue off the extraordinary capabilities off of that model. Instead, it's withholding it and only releasing it privately to a trusted select group of businesses and government agencies to help them patch their security vulnerabilities before it's too late. But while Anthropic is out front with this new era of AI capabilities, we should expect others in the field, other US companies, other companies in China, for example, to reach this level of capability at some point. And that's why it's very important that we use this critical window of opportunity to strengthen our cybersecurity defenses before China reaches the same capability threshold.
I know this is kind of an apocalyptic scenario, but are we going to have to go back to basics on the internet? I mean, will things like secure banking be even possible in an era that where we've got these models?
Yes, I think fundamentally this can work, but the future being good is not guaranteed to us. It must be the result of our efforts and our wisdom. And in this regard, as I said before, these advanced AI capabilities can be used to strengthen cyber offensives, and they can also be used to strengthen cyber defenses. And the fact that Anthropic is deploying these capabilities in this kind of a way shows you what the future is going to look like. It really depends upon the good guys having a technological edge and being able to reach that next threshold of cybersecurity defenses before others are in a similar position of capability and coming up with better hacks. That's the challenge that we're in right now. But it's also worth pointing out that we've already been living with a pretty significant degree of cybersecurity vulnerability that's held in place both by geopolitics and the general deterrence between various countries, and also the labor shortage that I talked about.
Wow.
So this AI situation is going to change the labor shortage dynamics, but as long as we're putting more and better resources towards defenses, yes, online banking and other critical online services can survive. We're
very tight for time, but a young person watching, a young person wondering where their career should go, if they're good at programming and math, should they think about a career in cybersecurity?
Well, I actually am one who thinks that the nature of AI progress, you can sort of look at where is there high quality training data, and you can use that to predict where the frontier of performance is likely to go. And the reason why computer programming and cybersecurity are so amenable to AI-empowered automation is that it is somewhere where you can, in a digital environment, effectively create your own training data by having an AI model, create programs, test them to see if they work, and then add the results of that test back into the training data corpus. So for students who are out there wondering, what are places that are going to be durable jobs, I think areas in which it's difficult to create new training data, where it's difficult to think about how exactly you're going to give an AI an opportunity to even learn how to do this job, those ones are going to be the highly desirous fields. But it's worth pointing out that Anthropic is still hiring. They're still hiring more programmers. It's just the nature of those jobs is more shifting towards supervising the work of AI agents as opposed to typing out lines of computer code by hand.
And he was speaking with Gregory Allen, former U.S. government AI policy official. As CUSMA talks approach, many Canadian companies are on edge about the potential impact. Our next guest breaks down what to watch for as negotiations loom. Ahead of tomorrow's spring economic update, Prime Minister Mark Carney announcing Canada's first ever sovereign wealth fund. Carney says the fund will receive a $25 billion endowment and will operate independently from the government. Here's the Prime Minister outlining the plan.
Today, we're proud to announce a new pillar of our plan, the Canada Strong Fund, Canada's first national sovereign wealth fund. This will be a Government of Canada fund, but more importantly, this will be a people's fund. It will be your fund.
Shares of Domino Pizza are down today almost 10% after missing on earnings for the first quarter. The decline was primarily due to a $30 million loss from its investment in DCP Dash, a food delivery service that relied on independent contractors rather than in-store employees. Despite the results, the company remains positive, citing its scale advantage and its relative resilience as the broader restaurant sector comes under pressure. Elon Musk and OpenAI CEO Sam Altman head to court today as their legal dispute over artificial intelligence gets underway. Musk is suing Altman, accusing the company of abandoning its original nonprofit mission in favor of commercial interests. OpenAI has pushed back, calling the claims baseless and saying Musk is trying to simply slow a competitor. The case is expected to spotlight how AI is governed and commercialized as the technology plays a growing role in the global economy. And looking at the markets, you can see TSX still down about 0.28%. Materials taking the biggest hit along with consumer discretionary. They're both off by more than a percentage point in the green energy right now in real estate. Down south of the border, they've managed to turn it around a little bit. They were down most of the morning, but now the S&P 500 up by 0.13. Dow floating around, it's off by 0.09, and the NASDAQ is up now after being in the red for most of the morning. It's up by 0.15%. As CUSMA talks approach, many Canadian companies are on edge about the potential impact. Our next guest breaks down what to watch for as negotiations loom. With CUSMA negotiations approaching, uncertainty is building for companies that depend on cross-border trade. Ottawa says it's ready to talk, but formal negotiations have yet to get underway. To break down where things stand and what it means for Canadian businesses, we are joined now by Wendy Wagner, Head of International Trade at Gowling WLG. Wendy, thank you very much for joining us.
You're welcome. Thanks for having me.
All right, there's no official talks. Are they chatting, though, or are they meeting in little private rooms off in corners somewhere and trying to figure out where this is going to go?
I'm sure there's discussions at some level, but we haven't heard a lot about that. So right now we're hearing mostly from the Canadian side and what they're doing in terms of putting together the advisory council and other preparations on our end.
And what do you think of that advisory council? Is that a good choice?
Yeah, I think it's great. I mean, I think we've seen that a lot of the tensions that Canada is dealing with and the most serious irritants are on a sectoral level. And the council has very good representation from each of those industries. So you can see where that would be very important to have those interests represented and providing the information that the negotiating team will need.
All right, I like the term irritants. It's very polite. Dairy comes to mind. Booze, maybe. What are some of the irritants, and what are some of the realities we may have to face with them?
Yeah, I mean, I think it's a really challenging environment because a lot of what the Carney administration is doing is reactive to what we've faced in terms of trade challenges from the United States. So, we've imposed retaliatory tariffs on steel and aluminum and certain derivative products, and that's obviously an irritant, but one that is in retaliation for what our industries are facing. And then there's some of those more traditional issues like dairy, and then some of the newer digital issues like the Online Streaming Act, Online News Act, and even the data sovereignty initiatives that we've heard of in the past couple of months.
Are all of them? Are they all on the table, or would we be willing to give up one of them or all of them?
I can't say what we'd be willing to give up, but I imagine that each of those issues will be a focus of the U.S. administration. They've already signaled what they consider to be of concern. So I'm sure there are issues that will be brought forward, but that's how the negotiations unfold in terms of what each party is willing to consider giving up or making some changes in relation to.
And do we have irritants? I mean, we have a lot of things I think we're worried about, but do we have irritants like that there might be a tit for tat?
Oh, absolutely. I mean, the greatest challenge focused or that our economy is focusing on right now is some of those sectoral issues. The steel and aluminum tariffs, 50%. It's a huge impact on those industries in Canada. Copper as well. Lumber, automobiles, of course, completely unresolved and, really quite devastating to our economy. So although we're still enjoying duty-free treatment for most of the products we send to the United States, we can't de-emphasize the impact of some of those very significant tariffs.
And any indicators on what might happen with those, or is it still a bit of a wild card with who's in the White House right now?
I think it's always a wild card, but I haven't heard anything that's particularly positive from the U.S. administration side in terms of their willingness to consider lifting some of those very significant tariffs, sectoral tariffs. And in fact, I think the signals that have been sent is that those are there to stay and in some sense not negotiable, maybe in some sense, but we have heard that tariffs will remain in some sense as well. So hard to say if there's a prospect of reduction and what that would look like.
And what are our bargaining chips then going into this?
Well, I mean, I think it's interesting. We heard talk about an entry fee into negotiations and a very sort of one-sided approach. One would have thought our bargaining chip is that if tariffs are imposed by the U.S., they're paid by U.S. businesses and ultimately U.S. consumers. So the theory behind free trade negotiations in the past has always been that free trade benefits both countries. So you're willing to come into the negotiations on that premise. If that premise is no longer one that the U.S. administration is committed to or believes in, it's, the negotiations become much more difficult and much different in character.
And I know, all these talks are obviously focused on the U.S. Do we have any concerns with Mexico? Like, are there anything that could suddenly loom its head and throw a spanner in the works?
Yeah, I think our major concern in terms of Mexico in the context of the CUSMA negotiations is that we've always considered those trilateral negotiations to provide a better path forward for us in terms of negotiating with the United States. I think we have to remember in terms of our own trade with Mexico, we are both members of the CPTPP, which is a separate free trade agreement. And so we would still have free trade with Mexico, even if CUSMA took a different form or ceased to exist.
And with the idea of us negotiating with the U.S. and Mexico negotiating with the U.S. separate, would that be good for Canada or could that be detrimental?
I think it's difficult to say in terms of outcomes. I think the desired process on the part of the Canadian administration is to do this on a trilateral basis. And Mexico has also voiced that as being a strong preference. I think there's a perception that, together we're a bit of a counterweight to the United States.
All right, Wendy, we have to wrap it up there, but thank you very much for joining us.
You're welcome. Thanks so much for having me.
Wendy Wagner, Head of International Trade at Gowling WLG. Well, the federal government announcing Canada's first sovereign wealth fund this morning. Our next guest had been calling for one for months. We find out why after the break. Members of the trucking industry say the high gas and diesel prices are causing them to limit cross-border trips. CTV's Kathy Lee has more.
The cost of doing business is rising for Sukdeep Dadian. With fuel prices remaining high, every trip is costing him hundreds of dollars more.
We are already struggling with the tariffs, but now after tariffs, it's the fuel, so very difficult time for the trucking.
Dadian operates several trucks for larger firms. He can't park them temporarily to save money, so he's cutting back on cross-border trips.
Due to the impact of fuel price, so we prefer to take the short routes, just keep the business running.
High gas prices driven by global tensions have persisted for weeks. An economist says even in an oil-rich country like Canada, prices remain exposed to global market swings.
The oil market is a globally integrated marketplace. The price that is set in the global market is the price that's used all throughout the world.
Perry Sidorsky says the International Energy Agency points to electric vehicles as a way to reduce the reliance on global oil markets. He adds limiting exports from Canada could also lower prices at home, but that would be politically difficult and cut into producer profits.
Consumers would be very happy. But producers would be very unhappy.
Another economist says boosting domestic production could help reduce Canada's vulnerability.
We would be more energy independent. That might decrease the volatility or our vulnerability, but it will not eliminate it because, again, it's a global market.
But experts say these are long-term solutions with little immediate relief. For now, Dadian is just trying to hold on.
I pray for the good future.
Hoping the price of gas comes down soon. Kathy Lee, CTV News, Calgary.
Well, Prime Minister Mark Carney announcing Canada's first ever sovereign wealth fund happened this morning. My next guest believes the fund could help the Canadian economy if, always an if, executed properly. Let's learn more on it. Let's bring in John Ruffalo, founder and managing partner at Mavericks Private Equity. John, thanks very much for joining us.
Thank you very much.
Okay, $25 billion sounds like a big number. Looks like a big number. Is it a big number?
It's a starting point. It's not a big number. I mean, in the context, it is the size of the Alberta Heritage Fund or thereabouts, but it pales into comparison of the Norwegian Fund, which is topping at around $2 trillion.
Yeah, that's not even close to that. You've been calling for this for months and probably longer, yes. I imagine. Will this make a difference at 20? It's a start, but will it make a difference? Will we see it used properly?
Yeah, now there's still lots of details to come out. You know, what I hope is that this is just the seeding of it. But there is an opportunity to really scale this up and really have a source of permanent capital, not only for Canadian investments, but to support the wealth of Canada by even investing abroad as well. So I hope this is just really the tip of the iceberg.
Do you think there's interest in wanting to invest in this?
Well, I certainly there's the opportunities. Now, the one thing that remains a little unclear to me is, you know, in the press release, they made reference to some infrastructure type projects, but there is a dearth of capital available for venture and growth opportunities, particularly in the innovation space. You know, in the age of AI, we're seeing all these countries around the world invest heavily. There's an opportunity to invest in Canadian-based opportunities here as well. So I want to understand more on the breadth of the opportunity, and I think more capital is welcome, and it might attract private sources of capital as well.
And how have we done at things like this? Are we any good at it?
Well, so this is the key here. So governance is absolutely critical. What no one wants to see is a government slush fund achieving, you know, really political points and money wasted. We need proper professional governance models like the CPBIB, the most recent Canada Growth Fund, CDPQ. There is a number of examples, but this is critical. The details haven't been released on that, but I'd be looking towards that to make sure we get it right.
And is there a legitimate worry that this could end up as a bit of a pork barrel?
Well, it is if it's just a crown corporation being dictated by whoever government is in power, then yes, that is the big risk. So, I know this government here was very concerned around the governance model. And so I am quite curious to see where they might be landing.
And what would you like to see for a governance model?
I'd like to see this independently managed with no political influence. And their job is to not only invest in Canadian sovereign opportunities, but also achieve a rate of return so that this continues to grow and is completely sustainable for all Canadians.
And what's a good rate of return to you?
So if you compare this as a proxy to the long-term pension fund rate using 20 plus years, every single major pension fund has generated a return of at least 7% compounded. And if the source of the capital is our debt or our bonds at 3.5%, then you're generating really a spread on our borrowing rate versus what you're able to generate. So that gives me optimism that we could replicate the Canadian pension fund success here as well.
And should we be modeling on another sovereign wealth fund that, like I know they have them in the Middle East? You mentioned Norway. Is there one that might be comparable to what we are hoping to do?
Well, I mean, there's a variety of them. There, as you indicated, the Middle East. There's a couple in Asia, but Norway is the example that most people use. At the time that it was created, it was approximately the same size as the Alberta Heritage Fund, but it had independent governance, and look at the difference. And the one thing that Norway had, which I think is interesting, there's actually two funds inside of it. One that exclusively invests in domestic sovereign opportunities in Norway, and a much larger fund that invests around the world in order to generate a consistent rate of return so that you have the money sustainably to make the domestic investments.
And is that working?
It's working to the tune of $2 trillion.
They had a tremendous amount of oil too, right?
Yes. And now this is the lost opportunity for Canada, is that, we had all these oil revenues, and we didn't have a big deficit. And if we did this properly, we would have started this 40 years ago. But the second best time to start this is right now.
And how is the Alberta one doing?
Well, not very good. It started earlier than Norway. It actually was growing larger. And then I cannot recall exactly. I want to say it was during the Ralph Klein administration that they took money from the fund to keep taxes lower and to fund the deficit. And others were pushing it for a sales tax, and they made a political decision. And today, I think the size is around $28 billion, and it could have been $2 billion or, thereabouts.
2 trillion.
If it was untouched.
And now, do you think politicians will have the stomach to step back and not have control over money?
Well, we did it with CPBIB, right? This is taxpayer money to fund the future CPB payments. And there's an independent board, independent management. It works extremely well. It works closely with the Department of Finance, but it is independently managed. So we have those models and a proven success story in Canada. Why not this as well?
Okay, John, thank you very much for joining us today.
Great. Thank you very much.
John Ruffalo is founder and managing partner at Mavericks Private Equity. And before we go, let's take a quick look at the markets and see what's unfolding there. It's been a mixed day. You can see the TSX slipping a little more, off by about 0.44 right now, just jumped. And materials taking the biggest hit there. Going the other way, energy is up by 0.62% at this moment. And south of the border, it is a mixed day. They've been all over the place right now. And you can see S&P 500 up slightly, Dow down by 0.18, and the NASDAQ up by 0.13. Just one of those days right now. It's a Monday. And that wraps up this edition of Trading Day. Thank you very much for joining us. Have yourself a great afternoon.